Hello everybody, welcome back. I'm Craig Berger, Hedgeye's technology sector head and semiconductor analyst. Wanted to talk to you today about large cap stocks in the chip space. Hedgeye's founder and macro team lead Keith McCullough is noting better performance in large caps and mega caps as investors look for liquidity, look to be in things that they can get out of if the market does pull back. So within that context, there's three names we're going to talk about: Texas Instruments, Qualcomm, and Intel. Let me start with Texas Instruments, which is our favorite large cap stock in the chip space. On Friday afternoon, the firm raised its dividend by 13%, 34 cents a quarter. It's a 2.7% dividend yield. It's not the highest in semis, but it is in the roughly top 10 within semis. Beyond that, the firm's only paying out 35% of their free cash flow today, so they have plenty of ammunition to raise dividends again further in the future. And whatever cash they're generating that they're not spending on dividends, they're spending on share repurchases. They're returning 100% of their cash flow to investors, and that is a very successful cash return policy. Also for Texas Instruments, they have a lot of unfilled 300 millimeter analog manufacturing capacity. They're the only firm with their own 300 millimeter analog fab. They can do about $5 billion more in annual revenues without needing to buy any more equipment, and so the profit fall through for Texan, should they acquire a large competitor in semis, would be very meaningful. We see a lot of potential accretion from a Texas Instrument acquisition, as much as 50 to 75% growth in EPS, and we think that can drive shares of Texas Instruments up 50% as well, towards that $70 to $75 level if they were to make such an acquisition. So Texan is our favorite large cap chip stock out there right now. The next name I want to talk about is Qualcomm, ticker QCOM. There's some good things and some bad things going on with Qualcomm right now. On the good side, they are in the Apple iPhone 6 and 6 Plus with their 4G LTE communications processor. They're doing a lot of business with Apple right now. They're doing a lot of business with the Chinese smartphone vendors as well, and so their chip business is pretty good. But the firm is in the penalty box with China, so to speak. China is encouraging some of its local homegrown smartphone manufacturers to underpay Qualcomm royalties, and China's looking to fine Qualcomm and rework Qualcomm's royalty deal, and so this is an overhang on the stock. Should this get resolved, the overhang will be lifted, but we don't think this is going to get resolved for Qualcomm until probably mid-2015 or later. The third stock I want to talk about is Intel, ticker INTC, another mega cap stock. It's been acting fairly well. It's appreciated pretty well into the $35 range. There's some good things and some bad things going on with Intel as well. On the good side, the company's re-energized under new CEO Brian Krzanich. They're also targeting new initiatives like Internet of Things, where they think they can grow revenues from $2 billion today to $6 billion in 2020. And they're continuing to see strength in server, which has been a very big profit center for them. Oh yeah, they also have a $20 billion share repurchase authorization that's active and quite sizable in the second half of this year. But for Intel, we see risks. Their business is still 80% PC exposed. We think PC has benefited from a corporate PC refresh, possibly some consumer PC refresh, and we're concerned that shipment rates are well ahead of end consumption on a sustainable basis. Intel unit shipments are up something like 8 to 9% year over year right now. We think end consumption in PC is about flat year over year. So we do see some risks. So in short, we like Texan best in mega cap, followed by Qualcomm, and we're neutral on Intel at the $35 level. Reach out to me on Twitter if you have any questions, at Hedgeye Berger. Thanks so much and have a great day.